Charles Dallara joins us this morning, former CEO of the Institute of International Finance, to talk more about just the remarkable week, Charles, we've had in currency and a lot of the commentary, SocGen, for example, today, calling the pound unbuyable. How do you describe this environment? Where do you think it's going?
It's a chaotic environment. There's no doubt about it. And I think we're heading more and more likely toward a recession. But obviously, there's a lot of uncertainty swirling around in the markets, and that's completely understandable given the state of the world economy and the uncertainty facing financial markets.
Do you feel this is getting overstretched? To what degree do we start talking about some mean reversion here?
Oh, I think we are at that point, really. I mean, I don't think a recession is necessarily inevitable, but it is highly likely at this point. I think it's almost unavoidable. I think the reality is that the seeds of this environment were planted a few years ago, particularly during 2020 with the strong expansionary fiscal policy of President Biden and with the continued expansionary monetary policy. And I think that with that backdrop, it's so likely now that we're going to have to restrain growth sufficiently to contain inflation. And for that to happen, I think that interest rates are going to have to rise considerably more. And I think we're going to find ourselves, as we may already be in a technical recession, but we're certainly not in a severe recession yet.
So it doesn't sound like you're putting a whole lot of faith in this week's price action, the rollover in some commodities, certainly the degree to which oil and energy is starting to moderate. You think the Fed still has some wood to chop?
Oh, absolutely. Absolutely. I do think, of course, the rollover in commodities to a certain extent does reflect the growing awareness in the markets that we may well be on a recessionary trend. And I think that's what the markets are telling us. That's what the 10-year is telling us. That's what the stock market's telling us. But at the same time, I would certainly acknowledge that the price pressures in the market are going to continue for quite a while. And I think the Fed is very concerned. And after procrastinating for quite some time, I think they're determined now to actually stifle inflation. And that more than likely will lead us into a period of some significant economic weakness.
Okay, but is it soft landing economic weakness or is it more serious?
I don't think it has to be a severe recession. I think the relevant question really is not the severity of it so much as the extent to which it drags on and on. And I think that's really a question we don't have the answer to right now. To me, this does have the makings of a potential stagflationary environment that could be with us for quite a while. I lived through the stagflationary environment of the 70s. I, unfortunately, am all too familiar with the efforts in those days to contain inflation, which really involved gimmickry and did not really tackle the underlying forces of inflation until it was really out of hand. Of course, that went on for nearly an entire decade, and we've not been in that inflationary environment as long this time around. So I think the Fed has a much better chance this time of containing inflationary expectations. But consumer surveys are already showing that inflationary expectations are drifting now. And I think this has to be of great concern. As a result of that, I do think that we're in a potential risk of a stagflationary environment.
Shepard Smith here. Thanks for watching CNBC on YouTube.